Howdy, Jacob here. Today we'll be looking at Civitas Resources, ticker symbol CIVI. Let's get into it. So, currently a 9.39% dividend yield, absolutely massive. Okay, oil, gas, consumable fuels industry, $6.4 billion market cap with a $10 billion enterprise. So, high level looks like a lot of net debt here. Um, yeah, they produce, acquire, develop oil and natural gas in the Rocky Mountain region out of Colorado. Okay, so um, God, whenever I look at oil and gas, just gotta remember that things that companies that produce and develop and acquire oil and natural gas is going to be very much dependent on the commodity price. And a bit oil's been inflated recently. Not saying I'm gonna presume where it's gonna go, um, but that would make sense why revenue has jumped up so incredibly high, being just as low as 313 in 2019 to 3.8 billion in 2022. They made four times the income that they had in revenue there. Um, the thing that I do like is that since 2018, they've produced positive earnings and can't quite say the same for cash flow. Looks like it's a business that requires a lot of reinvesting just to keep the doors open, metaphorically. All right, so let's look at that debt that made the enterprise value so high. Um, okay, so long-term debt is at 400 million, which is really nothing since last year they made 1.1 billion in net in free cash flow. Um, a lot of changes. 2020 to 2021, they gained almost 5 billion in property and plant, and it looks like they sold something off. So these type of this companies, for some reason, it's so weird. I really want to dig more into them, but again, that's the great thing about so many companies being out there is that you don't have to understand every single company. You just have to understand the ones that are close to buy prices. So, with that said, honestly, let's just get to making some assumptions here. So, I mean, again, I'm seeing a cyclical business. It could easily drop down like crazy. So, I might just do zero and like classic 0 and 10. We're saying, maybe it goes down and then comes back up, but over the 7 year period, I'd see it being kind of flat. Um, Earnings have been all over. We'll do pretty different earnings here. Let's do maybe 15 and 25, see how that looks. They've been increasing shares pretty heavily. Looks like through stock based compensation. So, maybe just 5% increase in shares outstanding. Then we're looking at a price that would need to fall 38% before it gets you the 15% return, given all these assumptions. So, first, let's see, 636. I mean, that's more than they made there, but if we're assuming flat growth, um, what'd that pay out? 677 million. I mean, I even cut that in half. Let's cut that. Let's cut that in half. Keep that the same after that because that's 300 million, which even then is a bold prediction. So that's saying it needs to fall 53%. So yeah, I just don't know about this one. I feel like there's a lot of other ones that make a lot more sense or a lot more consistent and everything. But yeah, a company that just requires so much reinvestment just to just to stay open. I mean, it's tough to. You really have to understand a business like this. So, all right. Well, thanks so much, everyone. Hope everyone has a good rest of their day. Thanks.